forever portfolio, but you always need to be. Remember and think that you are looking to buy companies at good prices. Not when they are overvalued. The next company that we are analyzing today is Starbucks Corporation. Now they are a multinational chain of coffee houses and roastery reserves headquartered in Seattle, Washington, and they are the world's largest coffee house chain. They were down 133% last year. They are now trading pretty much towards that 52 a yield of 2.5% and a forward P of 22 over the last 10 years. You would be up, however, around 146%, and we can see their all-time highs in summer of 2021 at around $126. Dividend safety, then it is 67. It is safe. Market cap $105 billion. Mega cap company in terms of the key metrics. Well, they didn't pay a dividend during the last recession. They had above average growth, but they did significantly underperform the S&P with a negative 669% return. Dividend increase though 1.2%. Nice to see. Last year 10% on average, 177% over the last 10 years. Lots to love here for dividend growth investors, and we can see they have been increasing those dividends for the last 13 years in terms of undervaluation theory. We can see here, or dividend yield theory, a sign of undervaluation, 2.48 versus 2.01, as well as that forward P sitting below the 5-year average of 29 in terms of the sector P. Well, consumer discretionary is still significantly lower at 14.4 now. In terms of the free cash flow payout, 67% in 2023, not too bad. 2022 was very high, so something just to bear in mind. It does fluctuate quite significantly. Free cash flow a share, where it went from negative in 2014, 320 in 2023, we can see it is very inconsistent and hasn't really grown too much over the last 10 years. Sales growth, though, pretty much double-digit every single year. We see that co-year, which is justified with lockdown, people not being able to buy their favorite Starbucks drinks. 2023 12% increase to the top line. Very nice to see sales growth, while 16 billion more than doubled over the last 10 years to 36 billion, and they've also bought back a heavy number of shares outstanding, dropping it from 1.53 billion to 1.15 now. ROIC, very nice to see the last few years, especially 33% in 2023. Very strong management. Get the deal of approval for me. When analyzing these stocks, operating margin, it has slipped 1 or 2 years, but overall it is string around that minimum. And we can say the same for the free cash FL margin. 10% in 2023 is very nice to see. Net debt to EBITDA 2.06 in 2023, 2024 expected to go lower, significantly lower than that 3.5 maximum, so that dividend doesn't seem to be a real worry in terms of safety, and the balance sheet looks to be positive for now. The valuation for Starbucks, we can jump into it, and we can see that in today's episode is just the average of these three. And the intrinsic value is coming to $110. Don't forget, if you're enjoying the content, smash that like button, hit that subscribe and bell button so you are continually notified of these videos, and just let me know in the comments below if you are adding any of these, and if you're enjoying today's different type of content. Margin of safety, then we start off with 10%. It looks to be a buy up to $99, 15% up to $93, and at 20% around $88. So right now you are locking in based on our estimates. Judgments around a 15 to 20% margin of safety in terms of Wall Street. Will they see the share price going up to $113, so they see some nice upside of 23%. Over the 12-month period, moving on to the next stock, we have the Home Depot. Now they are a multinational home improvement retail corporation that sells tools, construction products, appliances and services including fuel and transportation rentals. We can see over the last year they have been pretty much up 8% there. Also trading towards the 52-week high with a yield of 2.35% and a forward P of 23.6. If you've held them for the last 10 years, you would be up 39%, and we can see their dividend safety sitting at 87. It is very safe market cap 354 billion. They are a mega cap company. Assessing metrics, well, they maintained the dividend in 07-09 above average growth, or in fact around average growth, and they did beat the S&P with that netted 44% recession return. Another key theme here with companies we are buying and holding forever: double-digit increase last year. We are expecting another increase this February, 15% over the last 5 years, 20% over the last 20 years, and they have been increasing those dividends for the last 14 years. In terms of dividend yield theory, well, we can see pretty much reasonable valuation, 2.35 versus 2.441, although we do not. The forward P is sitting slightly higher than the 5-year average. And when we compare it to consumer discretionary, Home Depot is sitting significantly higher now in terms of that free cash flow payout. 2023 actually went above the trend at 69%, a bit of a red flag indicator, but it is positive given it is expected to come down to 52% in 2024. Free cash flow per share, well, it was increasing very nicely to 2021. But it has started to come down, but over the longer term it is moving in the right direction, and it does give us faith given that 2024 is expected to go significantly higher sales growth than single-digit increases year on year. Other than 2021 and 2022, 2023 it did drop to 4%, still within the 3 to 7% we look for steady moderate growth, for something just to keep an eye on moving forwards. Total sales, well, it has pretty much doubled from around 79 billion to 157 in 2023, and I do love this management. They are buying a lot of shares over the period from 1.43 billion to 1.03. Remember, it is essentially returning excess cash to your pockets. ROIC should come as zero. Surprise, very high 45% in 2023 is astronomically good for any company, so that is very positive to see. And when we analyze the operating and free cash flow margin, nothing much to say other than the fact that it is very positive, above the minimums, and very consistent. So that is a big tick for the Home Depot. In terms of the net debt to EBITDA, again pretty consistent as well, 1.66 in 2023, below